Hello, everyone. Thank you so much for joining us again for another weekly wrap-up. My name is Jeremy Cronemeyer. I'm Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets?
Yeah, thank you, Jeremy. Thanks for our listeners jumping again on the call. Kind of a mixed performance for the S&P. That was down about 1%. On the flip side, we saw the Nasdaq, which pretty tech focused. That was hitting some new record highs. If we look at the Russell 2000, that small cap area, that took the blunt of the pressure. That was down about 3%. We saw industrials, basic materials, all underperforming. But if we look over at oil and Treasury yields, we saw crude oil prices rise about 4%. On the other side of that, we saw the U.S. Treasury yields increase, meaning pushing prices down on those bonds, with the 10-year note reaching about 4.25. Now, keep in mind, it really started pulling back as soon as the Fed lowered rates in September. It was almost on the dime when they lowered rates. My thought on that is, the market just got too far ahead of itself. Maybe it priced in too much of a rate cut too quickly, and I think it's backing back up here. So if we look at some economic data, we look at the manufacturing optimism for the PMI, that moved to about 54.3. We saw the jobless claims fell to about 227,000, and we did see consumer sentiment hit some 6-month highs. Federal Reserve, they are expected to cut interest rates about 25 basis points in November, though future rate cuts may be slower, again, putting pressure back on those yields that moved down so much on that 10-year so quick, so fast. And I think they're backing back up, meaning going back up, because maybe it's not going to happen as quick because we're still looking at a really strong U.S. economy, and we're right in the middle of earnings season, and we're expecting those to be strong as well. But we'll look at some housing. The housing market, existing home sales fell about 1%, while new home sales were pretty strong. We look at global outlook, the IMF optimism about the U.S. growth, but concerns about some European productivity. The central banks overseas, we saw the Bank of Canada cut those interest rates 50 basis points as expected to follow us. But we're going to be looking at Europe and the UK. Saw some weakness in their business activity, where we saw Japan's CPI fell below target, but some further rate cuts still are on the docket, still expected to happen. I think the key here is this week. This is a really big earnings week. We're looking at some major companies, that Mag 7 that's driving the market. We got Apple, Amazon, Meta, Microsoft, Google, Alphabet, and AMD, all reporting earnings, setting the tone on the market as we're coming into election time. And honestly, one of the best times of the year, from November through the first of the year, is one of the best times in terms of performance for the indices. But from a U.S. economic data, we'll be looking at some monthly job reports. Q3 GDP will be coming out, some PCE price index. If we look at the GDP growth numbers, now they're expected to come out at about 3%, and that's strong for the third quarter. We even have the Atlanta Fed coming out with their modeling, predicting even higher than that, from about 3.4. Keep in mind, we want to have a strong growth, but not too strong, because inflation might rear its head again, pushing those yields higher. And sooner or later, it could affect the stock market, but not right now. The labor market, we'll be looking at some October non-farm payrolls. They're expected to be somewhere around half of the previous month, somewhere around 254K. We're looking at Federal Reserve. The data will influence pretty much their policy and their decision. But again, we're looking at 25 basis points. What they do after that in November, that's really the question right now. Jeremy?
Got it. Well, Graham, I had a couple questions for you. The first one, I know we're 7 days out from the election here. Maybe what do you think that might be doing to the markets here going for the next week?
Well, I think it puts a bit of a nervous tone in the market, right? We know someone's going to be elected, and we know there's a 64% chance that's probably going to be a split, not between the Republican or Democrat, but maybe the House, the government, if you might. And that might be the best tone for the market, feeling that no one can have a leg in one direction or another. But I think it's the question mark. The market's hit some new highs. Yields have been pulling up. I would not be surprised to see some volatility in the equity side, especially with those yields popping up as we go into the election. Now, if we see a contested election and it seems to be protracted, all bets are off. The market could get pretty upset about that, really see some volatility. But keep in mind, we got the Fed still looking to lower interest rates. The pace is in question. And we're moving into one of the best times in history in the market, November plus. So that's a nice little backstop.
Gotcha. Well, going back to that question, you mentioned a couple of times about yields. Maybe you can elaborate a little further on the 10-year yield and what's going on with it right now.
Yeah, I think it's the pace and tenure of what the Fed's going to be doing. And the market was pricing in that, hey, listen, this Fed's going to really lower interest rates really quick, really fast. And maybe for some, myself, I think it was a little bit of a surprise to see them lower 50 basis points right off the bat. And maybe there's some real question here. If we are looking at a gross domestic product of 3% or better, we got strong earnings, the consumer is still spending. What are they going to be lowering aggressively interest rates into a strong economy where we could actually see inflation heat up? And I think that's the concern here. Do we need to be aggressive about lowering rates in a strong economy where inflation can kind of remain sticky and heat up? And I think that's why the yields are backing back up. I know that's why the yields are backing back up in many cases. I think it just got a little ahead of itself. But I do want our listeners to keep in mind, the pace is still down, right? You can't ever control a week, a month, 6 months, a year necessarily, but the pace is still down in interest rates. And as long as we're not seeing a recession, and we don't, that's still pretty strong for stocks and bonds, at least from a history standpoint.
Gotcha. We always appreciate the expertise, Graham. And to our listeners, check in. Next week, we'll be doing another weekly wrap-up on Election Day. So you never know how it's going to look there. So we appreciate it. If you haven't checked out our weekly wrap-ups, go check out our website or our social media pages. And they're all on there from previous ones and for this one today. So we look forward to seeing you next week.
Take care.